which cannabis subsectors are still attracting equity capital. We're going to take a look at Viridian Capital's chart of the week coming up.
It's only entertainment.
Welcome back to the Talking Hedge. I'm Josh Kincaid, capital markets analyst and host of your Cannabis Business Podcast.
On this graph, we're taking a look at equity capital raises in the cannabis quarter or cannabis industry by quarter. So taking a look at from 2019 to 2020, every quarter, taking a snapshot there. So looking at the second quarter of 2022, that's representing March 31st through May 20th. So maroon line on this graph, looking at the price of the YOLO ETF, it's cannabis exchange traded fund, using that as an indicator for cannabis equity prices. The entire industry, not just cannabis, but VCs as venture capitalists have really kind of stepped off to the side. So everyone and their mom is on the sidelines right now. Steep decline in equity capital raises just in the last few weeks, the last month, but year to date is significant compared to last year. In 2020, we saw a bit of a decline with the pandemic. People jumped back in 2021, looking at when people were remodeling houses and going through a lot of the exercise craze and all of that. But a lot of those discretionary stocks have taken a hit, and consumer staples, those are the important things, are really doing well. Cannabis, they never have. They're really just news and momentum. So nothing new there, but the equity side, raising capital, really kind of taking a hit with the everyone else's portfolio. Investors are no different. They're emotional. And when their personal portfolio gets hit by 30%, maybe they're going to be less likely or inclined to invest in the private equity markets. Historically, we've seen a lot of investment on the retail and the cultivation side. People want to have quality control from seed to sale. The packaging and branding in the middle, those are their own beasts. People will go out and select or buy individual brands. Those typically come with either the production cultivation facilities or retail if it's fully vertically integrated. So seeing a lot of cultivation retail, that was about $14 million or 1.6% of the equity raised in 2022. Not a lot compared to the 1.9 billion or 52% of the capital that was raised in 2021. And that's probably going to continue for a couple of reasons. One, that MSOs have been able to use the equity for acquisitions. So they're not going out raising capital to buy things. They're just using the equity to make acquisitions. So that's a company that doesn't really, can't really afford to ask for money. And so they're just willing to be acquired using capital. So that means it's going to be fully accretive, meaning the deal is better together than separate, and that the company wanted to exit anyways. Another reason is that you have these tier one multi-state operators. They got a strong cash position. So that's going to have a lot of free cash flow. They don't know what to do with it. That happens a lot when you have a bear market. We haven't seen one for a long time, but you're going to start to see a lot of acquisitions because people don't know what to do with the cash. They're not going to reinvest that into the market. They may not buy their stock back, even though it makes more sense now than ever as stock prices are going down. So they're going to start looking at acquisitions. And then another reason for the trend to maybe continue is that you have a greater availability and better pricing of debt. We've mentioned before on the podcast that debt issuances are a sign of maturity and FOMO, both. One, maturity, meaning that the market it has not just speculation, but has real merit. So there's some fundamental maturity there. And so you're able to issue debt to a sophisticated investor. Another one is FOMO. People are willing to accept whatever they're offered. So it doesn't really matter if there's equity or debt, they'll just take it no matter what. When you look at the M&A side, and you look at some of those SPACs, so especially purpose acquisition corps, and the de-SPAC process, which got them absolutely annihilated. Those are completely out of favor. They made up 9.9% of this year compared to 16% last year. You'll probably see 0%. The crazy poor performance of the de-SPAC process, you're just not going to see that anymore, I don't think. And when you look at real estate, a lot of real estate investment trust REITs, IIPR, the sale leaseback options, those are going to have some more competition, with other folks in the industry. I think with some of these leaseback providers are going to be in kind of a world of hurt, really, if people stay at work from home and you see a correction in some of the commercial real estate sectors as people continue to leave New York for Florida. We'll see what happens there. But there's a rising trend for greater use of debt capital. And so that was 47% this year compared to only 7% last year, a lot more debt. So there's some expectations that there's going to be some legalization talks, at least. That's going to have some volatility with the stocks. So might be difficult to rebound from some of the recent lows. It's going to take some news and some pump and dump like press releases for individual equities to move, but the market as a whole probably won't move until this fall with the midterm elections and some of the things that are happening there. Moving on to the software media companies. Taking a bigger piece of financing. So that's 22% year to date. It was only 7% last year. So more than 1/5 are looking at an aggregation. And that is really just recently too. So I think there's a lot of data back behind there. So that probably will continue as people want to kind of build their channels in ways that they're able to get some messages across. When you look at the agricultural technology, it's down year to date. And then some of those multi-state operators probably have some redundancies, and so they're stepping away from that, probably just trying to get their branding out there right now. Stizzy's has really good branding, and so does Burner with Cookies branding, really, really good branding. But hopefully some of the genetics and quality will catch up to that. All in all, the last 5 weeks or so, last couple of months really have been really bad. And so cannabis, I don't see people jumping on board. NFTs are completely dead. And cannabis for now, I think is toast. Financial technology is really the last thing to die. I'm in that sector as well, and there's still money to be made. Investors are still looking for financial technology because it's the first bear market in over a decade, and entire generations who don't know what to do, when investing in pot stocks or otherwise. So that's going to dry up really, really soon, but that's kind of the last sector to, shit the bed. All in all, it's a tough market right now to raise capital. If you don't have revenue, it's really tough. Either you're going to have somebody with FOMO who says, okay, they're not raising capital, but what they're doing is really, really neat, or you're raising so much, you're generating so much revenue that someone's going to come in and give you capital. Outside of those two scenarios, I don't think you're going to raise capital at all. And in the cannabis industry, if you aren't generating revenue, nobody's going to be looking at you. That's my opinion. Let me know what you think.
With that, we're going to roll this one up. I'm Josh Kincaid. This is The Talking Hedge. Don't forget to like, share, and subscribe, or don't, and I'm out. Don't forget to smash that like button on your way out and check out these other videos that we've got.